Welcome to Build Break Finance Edition. I'm Owen.
And I'm Hope. Today, we're doing something different. We're diving deep into the world of financial technology being built by indie makers, solo founders, and small teams. We've analyzed 18 different finance and fintech projects, pulled from Hacker News, What Are You Working On? Threads. And what we found is fascinating.
Before we jump in, let me give you a preview of what we'll be covering today. We've got a surprising number of people, 4 separate teams actually, all building free open source invoice generators. We'll explore why this seemingly simple problem keeps getting rebuilt and what that tells us about the state of B2B financial tooling.
We're also looking at some really ambitious projects. AI-powered market prediction tools scraping the web for financial intelligence, peer-to-peer insurance schemes trying to make insurance NPV neutral instead of negative, and a platform that lets you charge customers as little as €0.07 per API request.
There's a fascinating tension running through all of these projects between what's technically possible and what's legally permissible, between building something delightful and building something sustainable, between serving occasional users and building full-featured business software.
And we'll be pulling in perspectives from the community, the challenges these builders faced, the skepticism they encountered, and the interesting debates that emerged in the comments. So let's start with the elephant in the room.
The invoice generators.
The invoice generators. 4 different people working independently, all built essentially the same thing. A free open-source invoice generator that works entirely in the browser without requiring sign-up. Why?
So let's talk about what they built first. You've got bestfreeinvoice.com by a developer named TickerFeed, who was frustrated trying to generate an invoice on their phone. They built a WYSRWYG editor where the invoice state is stored in the URL itself, compressed and encoded with LZ string. If you've sent someone an email with the link, you've got a copy. No server storage, no database, completely stateless.
Then there's EasyInvoicePDF.com by VLDSSN, which is the most feature-complete of the bunch. Live PDF preview, VAT support, multi-language, 10+, multi-currency, multiple templates including a Stripe-style invoice. It's open source under AGPL 3.0 with a dual licensing model. Free for open source use, commercial license available.
The other 2 are variations on the same theme. But here's what's interesting. In the comments, you see this really long, detailed critique by someone named Leon M. about how developers fundamentally misunderstand invoicing.
I read that comment. It was brutal but educational. The argument is that invoicing isn't really a standalone product. It's part of accounting, which is part of bookkeeping, which is part of your ERP system. An invoice is supposed to be a non-mutable entry in the ledgers of both parties. Most countries, especially in the EU, mandate invoices for B2B transactions, and they're tied to your books.
And Leon M. argues that any serious business will use accounting software with built-in invoicing. These standalone invoice generators only make sense for very occasional use. Freelancers who send maybe 3 invoices a year and track everything in a spreadsheet.
Which is exactly the market these builders are targeting. TickerFeed explicitly says, I found all the existing solutions to be quite awful. Forced signups to paid subscriptions, clunky interface. They're solving their own problem as occasional invoicers, not building a business solution.
But there's a deeper problem here that emerges in the comments. Someone from Italy mentions that in their country, every invoice, B2B or B2C, must be sent electronically using a government-defined XML format through a centralized system called Sistema di Interscambio. It validates and registers the invoice before forwarding it to the recipient.
And Germany is phasing in mandatory e-invoicing with the E-Rechnung directive, requiring standardized metadata. The EU has EN 16931 as a compliance standard. So these beautiful, simple invoice generators work great if you're a US-based freelancer sending occasional invoices, but they're potentially non-compliant in jurisdictions that require structured data formats.
To their credit, VLDSSN has an open GitHub issue tracking e-invoice support. They're aware of the problem and planning to address it. But this highlights a pattern we see repeatedly in these projects. US developers building for the US market, then discovering that international compliance is vastly more complex than they anticipated.
The invoice generators also illustrate another tension, the long URL problem. Storing state in the URL means you get these obscene 700, 1400 character URLs. One commenter suggested remapping JSON keys to numbers before compressing, turning VAT table summaries visible into 2 which cut the URL length in half.
It's a clever hack, but it reveals the fundamental trade-off: complete statelessness and privacy, no server storage, no databases, no user accounts, versus user experience, manageable URL lengths, easy sharing. You can't have both without introducing some server-side storage, which defeats the whole point.
Let's move on to something that's trying to be bigger than just occasional invoicing. FinBodhi. This is a local-first encrypted personal finance tool built on double-entry accounting principles. It stores data locally in SQLite in the browser, syncs across devices, backs up to local file system, and soon, Dropbox.
The creator, Siju, describes it as a perspective shift because it's using proper double-entry accounting instead of the simplified single-entry systems most personal finance apps use. They're building it as a PWA, Progressive Web App, so it works on any device with a browser.
But here's the challenge they're facing. It doesn't support bank linking. One commenter says, "The killer app I want in a personal finance app is to track my actual income and spending, and FinBodhi requires manual data entry." The creator acknowledges this is partly a limitation of being a web app.
This is the curse of local-first architecture. You get data ownership, privacy, offline functionality, but you sacrifice integration with external systems that require secure server-side credentials. Bank linking requires API keys, OAuth tokens, secure credential storage, all things that don't work well in a purely local-first model.
It's interesting because the creator is making a principled choice. Your financial data is stored locally on your device, is literally the first thing they highlight. But it means they're competing with apps like Mint or YNAB that have spent years building bank integrations and automatic transaction imports.
There's also a fascinating technical stack discussion in the comments. React, TypeScript, Tailwind, D3 for visualization, Vite for packaging, SQLite for storage, Evolue for schema and sync, Firebase for auth. It's a complex architecture for what they describe as front-end code, with a small sync server for encrypted data.
Let's talk about a completely different approach to personal finance. The peer-to-peer phone insurance app by Dax Axelrod. The thesis is simple. Insurance is negative NPV, trying to make it NPV neutral by giving people tools to self-insure.
The app lets you pool premiums with friends and family to self-insure your phone. They're actually using it. The creator and their friends pay premiums every month and have put aside $1,100 so far. It's a real experiment, not vaporware.
But here's the question that came up in the comments. How would you make money? Because if insurance is negative NPV for consumers, that means it's positive NPV for insurance companies. That's their business model. If you make insurance NPV neutral for consumers, where's your revenue?
I think the answer is they're not trying to build a traditional insurance company. They're building tooling for self-insurance. Maybe the revenue comes from transaction fees, premium management, claims processing infrastructure. But the fundamental model is different.
There's also the regulatory question. Insurance is one of the most heavily regulated industries. Are they operating as an insurance company? Do they need licensing? What happens when someone files a claim and the pool doesn't have enough money? These questions didn't get answered in the thread.
Now, let's talk about financial decision tools. There's this beautifully designed project called tinkerdeck.com, projects rent by, growth by Weepinbell, who's trying to make one of the biggest financial decisions of their life, whether to buy a house, and found that standard rent versus buy calculators are both extremely sensitive to assumptions and using questionable defaults.
The tool lets you explore how different assumptions about home appreciation rates and S&P 500 growth rates affect the outcome. They found that using national 20th percentile numbers instead of the defaults in NYT's calculator changes the rent-buy difference by more than $1.5 million over 25 years.
$1.5 million. That's not a rounding error. That's the difference between buying is obviously better and renting is obviously better. And it all comes down to what assumptions you plug into the growth rate fields.
One commenter shared that they ran Monte Carlo simulations that concluded buying was a bad idea, bought anyway because of COVID uncertainty, and their projections were completely wrong. The market went up. The lesson? You can't predict the future.
This raises an interesting philosophical question about financial tools. Are they helping you make better decisions, or are they just giving you false confidence? The tool itself is valuable for exploring sensitivity to assumptions, but it doesn't tell you which assumptions are correct.
Let's shift to market intelligence and trading. We have 3 projects in this space that take very different approaches: an AI-powered market prediction app, a stock market forum called TickerFeed, and AssetRoom, which sends email summaries of SEC filings.
The AI prediction app by SilentM68 is both ambitious and problematic. They're using Google's Gemini AI to search the web for information about various assets, crypto, stocks, etc., and generate price projections. They claim the results are very accurate.
But when you dig into the comments, you see the challenges. They're using free-tier AI tools because money is tight. They found assets with potential for 10,000% gain, but don't know if it's an accurate prediction or a massive hallucination. They have no test money to validate the predictions on a real trading platform.
And here's the fundamental problem. If you build a trading system that actually works, the last thing you do is tell people about it. You use it yourself, make money, and keep quiet. The fact that they're sharing it on Hacker News suggests either they don't think it works well enough to profit from, or they're hoping someone with resources will fund its development.
There's also a detailed technical explanation in the comments about how it works. It's not using traditional quantitative models like ARIMA or LSTM. It's using Google search grounding, having the AI search the web, analyze sentiment, synthesize information, and make predictions. It targets specific data sources like SEC Edgar filings, company press releases, technical analysis sites, crypto launchpads.
The chart generation is particularly interesting. It uses deterministic linear interpolation with algorithmic noise seeded by asset name and date to make charts look realistic but stay stable for the day. So the charts aren't based on actual historical data patterns. They're generated to visually connect current price to AI-predicted future price.
Which brings us to TickerFeed, which is taking the opposite approach. No AI predictions, no automated trading. Just old-fashioned human discussion about stocks and companies. The creator, SethOps1, built it after taking time off from corporate life following the HashiCorp acquisition by IBM.
He describes Reddit communities like stocks and WSB as having been substantially degraded by memification. He's trying to recapture what was lost, a platform for meaningful, long-form content about investing.
The tech stack choice is interesting. Go plus HTMX SQLite. One commenter describes this as a dream stack, and another praises the site loading speed. It's a deliberate rejection of heavy JavaScript frameworks in favor of server-rendered HTML with HTMX for interactivity.
But here's the challenge. Community building is hard. You need critical mass for discussion forums to work. You need to attract quality contributors and moderate out low-quality content. Reddit succeeded not because of technology, but because of network effects and community norms that developed over years.
AssetRoom takes yet another approach, pure information delivery. It sends email summaries of SEC filings from companies you want to follow. The creator, Aarons, describes a common pattern, reading about interesting public companies, but failing to keep up with them over time, then discovering months or years later how successful they were or weren't.
It's addressing information overload. SEC filings are public but dense and difficult to pass. By providing noise-free, easy-to-digest summaries, they're adding a curation layer. The challenge mentioned in comments is formatting. Big blocks of text are hard to scan. Bullets and structure would help.
Now let's talk about something completely different. gtmintel.com. This is an email newsletter tracking venture capital funding rounds, but with a twist. It uses AI, Perplexity Deep Research, to infer what services newly funded companies might need to outsource.
So if a company just raised a Series A, gtmintel tries to figure out, do they need cloud infrastructure support? Do they need specialized consulting for regulatory compliance? Are they likely to outsource HR, legal, marketing? It's B2B sales intelligence with an aviation aesthetic built in Rust.
The value prop is clear. If you're a service provider, consulting, infrastructure, recruiting, whatever, and you want to know which companies just got funded and might need your services, this is your lead generation tool.
One commenter pointed out that the descriptions looked way off, but the creator clarified that what looks like a description is actually the likely to outsource column, the AI's inference about what the company might need. For Slash's funding announcement, it suggested cloud infrastructure support to manage rapid scaling and specialized consulting for FinTech compliance.
The accuracy of those inferences is crucial. If the AI consistently gets it wrong, the tool becomes noise rather than signal. But if it's even moderately accurate, it could be genuinely useful for sales development.
Let's talk about Lunova, a QuickBooks online app that sends custom alerts via SMS or email when specific financial events occur. Big deposits, overdue invoices, vendor price spikes. The creator, Chidong1212, spent over 3 months going through Intuit's tech, security, and marketing review process after building the MVP.
3 months of approval process after building the product is brutal. That's 3 months of waiting before you can even start getting customers. And then there's the QuickBooks Partner Program, which starts at $300 a month. A stiff payment, in the creator's words.
This illustrates the challenge of building in someone else's ecosystem. The QuickBooks API itself seems workable. 500 calls min, 10 concurrent per realm, manageable if you implement rate limiting and batching. But the gatekeeping, the approval process, the partnership fees, these are barriers that favor established players over indie hackers.
There's a comment from Dalem Hurley that captures the shift. It used to be that being an ecosystem partner was something companies wanted as it solved the issues for their customers. Now they use it as another revenue source. Platform risk isn't just about APIs changing, it's about business models changing.
Now let's talk about something that seems almost anachronistic. Check.supply, an iPhone app for mailing physical paper checks. You link your bank account, type the amount, and they print and mail it for you for $7 per check.
For anyone outside the US, this is baffling. One commenter says, "I don't think I've seen a paper check in over 20 years. Another commenter who built something similar 15, 20 years ago asks, "Bravo to you if you have people paying you $7 check."
But multiple commenters point out that major US banks already offer bill pay services that mail physical checks for free. So the value proposition is presumably better UX, faster service, or additional features like certified mail tracking. But it's competing with free.
There's something charming about building modern technology for legacy systems. It's the opposite of cryptocurrency hype. This is taking an old, established, boring payment method and making it slightly more convenient via modern mobile interfaces.
Let's talk about one of the most technically interesting projects, Small Transfers, a micropayment platform by Stranisa that lets you charge as little as $0.01 per API request.
The key insight is batching. Traditional payment processors charge fixed fees. Stripe charges 30 cents plus 2.9% per transaction. That makes micropayments impossible. If you're charging $0.01 per API call, you lose money on every transaction.
Small Transfers solves this by tracking usage internally and batching it into a single monthly charge via Stripe. So you can charge a customer $0.01 per request, accumulate charges throughout the month, and settle once with a single Stripe transaction.
The challenge is that customers have to create accounts and link payment methods upfront. One commenter asks, "Isn't this just PayPal?" The creator explains, "No wallets, no pre-funding, no stored funds, no P2P transactions. It's an API that lets merchants charge tiny amounts programmatically."
There's an interesting detail in the comments about what happens if a customer's balance is under $1 at the end of the month. They delay charging for up to 60 days. If it's still under $1, after 60 days, they charge at least $0.50 and credit the difference to the customer's account for future use.
This is necessary because of payment processor minimums, but it introduces complexity. You're managing credit balances, sending reminder emails, implementing minimum charge thresholds. It's not as clean as truly frictionless micropayments would be.
Let's talk about 2 tools for information aggregation, a business for sale aggregator for Australia by David Soyevich, and a rent versus buy calculator we already touched on.
The business acquisition aggregator is solving a real pain point. In Australia, there are over 15 business for sale platforms with a minimum of 1,000 listings each, and at least 10 platforms with 1,000 listings. If you're looking to buy a business, you're burning hours looking through them individually.
The tool scrapes data from 12+ major platforms, deduplicates listings, extracts key financial metrics like revenue and profit, and normalizes it all for quick browsing. They're tracking just shy of 90,000 unique listings after deduplication.
But here's what's interesting in the comments. Someone points out that in the US, most commercial real estate and business sales are unlisted. Brokers rely on their networks. Even listing sites only reflect a minor percentage of what's actually available. You'd find more by driving around looking for sale signs.
A commenter from Australia confirms this is an issue there too. Brokers need to be licensed real estate agents, so there's a decent culture of listings, but hidden gems are businesses whose owners are near retirement and haven't planned for a sale. They're just intending to shut down. You have to approach them directly or ask accountants for leads.
This raises the question, is aggregating listings solving the real problem, or is the real problem that the best opportunities aren't listed at all? Maybe the valuable product is a database of businesses with aging owners, not a database of listed businesses.
Now let's talk about the bill splitting app by R. Mishra, snapreceipts.fyi. Upload a photo of a receipt, it uses LLM-based OCR to parse items, you assign items to people, it calculates who owes what.
When asked about the OCR approach, the creator says, I just use an LLM with a prompt. Pels don't hate, found Tesseract to be very bad for text extraction. That parenthetical, Polls don't hate, is telling. There's a bias in the developer community against using LLMs for tasks that feel like they should be solvable with traditional algorithms.
But if LLMs work better than Tesseract for receipt OCR, why not use them? The creator is using free API keys and limiting hosting costs. If users hit rate limits, they'll ask for financial help to keep the service up. It's a pragmatic, sustainable approach.
The challenge with any bill-splitting app is that it requires social coordination. Everyone in your group needs to use the same tool. There's network effects, but at a small scale, within your friend group. That makes growth difficult, but stickiness high.
Let's talk about the Dark Pool Trading Analysis project by Zinc. They're dissecting stock market data with code to see how dark pool and automated trading behaviors are evolving and impacting the market.
The description is fascinating. The market is the most adverse possible brain battle where actors constantly try to outsmart and make money off of each other. Greed and fear playing out and conditions changing constantly. AI is also used, but it gets funny when the market adapts and plays against past behavior to take advantage of AI traders as well.
This is adversarial co-evolution in action. As more traders use AI, the market adapts to exploit patterns in AI trading behavior. Any consistent strategy becomes a target. If AI traders tend to buy on certain signals, human traders learn to front-run those signals or create fake signals to trigger AI buying.
Unfortunately, the comments are mostly people asking for more details. Where did they get the data? What are the findings? There's no follow-up. This is common in "What are you working on?" threads. People share tantalizing hints of interesting work, but don't provide enough detail to evaluate it.
Finally, let's talk about Financé, spelled Financa, by Hugh. It's a personal finance tool with a simulation engine that lets you forecast spending and model life scenarios, taking a year off, getting a cat, moving to a new city, based on your current spending patterns and assets.
The name is causing problems. Multiple commenters say they read it as "my fiancé," the person you're engaged to, instead of "my Financé," a play on finance plus fiancé, suggesting you should love your finances. The creator acknowledges, the constant confusion has led me to strongly consider a rebrand.
This is a reminder that naming matters. A clever pun that requires explanation is worse than a boring descriptive name. If every user has to have the name explained to them, you've added friction to adoption.
But the simulation engine concept is genuinely interesting. Most personal finance tools focus on tracking what happened. This one lets you model what might happen. What if I quit my job for a year? What if I move to a city with higher rent? It's scenario planning, not just accounting.
So what are the big themes here, Hope? What patterns are we seeing across these 18 finance and fintech projects?
First, there's a massive disconnect between what developers think invoicing is and what it actually is in regulated markets. The 4 invoice generators are solving a real problem for U.S. freelancers, but they're potentially non-compliant in markets that require structured e-invoicing formats.
Second, there's a tension between privacy/data ownership and integration/convenience. FinBodhi chooses local-first architecture and sacrifices bank linking. Most successful personal finance apps choose integration and sacrifice privacy.
Third, building in someone else's ecosystem, whether it's QuickBooks, Stripe, or bank APIs, introduces platform risk, gatekeeping, and revenue sharing that can make indie projects economically unviable.
Fourth, there's adversarial dynamics everywhere. The AI prediction tool finds signals, but the market adapts to exploit those signals. Insurance companies make money because insurance is negative NPV for consumers. Peer-to-peer insurance tries to flip this but faces regulatory hurdles.
Fifth, network effects matter enormously. TickerFeed needs community scale to compete with Reddit. Bill-splitting apps need your entire friend group to adopt. These aren't technical challenges, they're social ones.
Sixth, the global nature of finance means US-centric tools often fail internationally. Invoice requirements, payment methods, tax regulations, they're all country-specific. Building something that works globally requires addressing compliance in dozens of jurisdictions.
Seventh, there's a pattern of sophisticated technical solutions to problems that might not need solving. 4 invoice generators all reinventing the wheel. Multiple market prediction tools. The interesting question isn't can you build this, but should you?
And eighth, monetization is hard. Multiple projects are free, ad-free, open source, which is great for users but doesn't create sustainable businesses. The peer-to-peer insurance can't figure out how to make money if insurance becomes NPV neutral. The bill-splitting app relies on users donating when they hit rate limits.
There's also something deeper here about what kinds of financial problems indie hackers can actually solve. Invoice generation? Sure, if you ignore international compliance. Personal finance tracking? Maybe, but you're competing with well-funded companies that have bank integrations. Market prediction? Everyone thinks they can beat the market, but markets are adversarial and adapt.
The projects that seem most viable are the ones that add curation or tooling layers on top of existing systems. AssetRoom curates SEC filings. gtmintel curates funding announcements and infers B2B opportunities. Small Transfers adds micropayment capabilities to Stripe. These aren't trying to replace existing systems, they're adding value on top.
Compare that to the projects trying to build parallel systems. Peer-to-peer insurance instead of traditional insurance. Self-hosted invoice generators instead of accounting software. Those face adoption hurdles, regulatory challenges, and the network effects working against them.
Although, to be fair, disruptive innovations often look like toys initially. Maybe peer-to-peer insurance is the seed of something bigger. Maybe local-first finance apps will find their niche. But right now, they're solving problems for a very narrow audience, themselves and people exactly like them.
Let's talk about the elephant we haven't addressed: trust. Multiple projects involve people's money. The AI prediction app admits it might be hallucinating. The bill-splitting app uses free API keys and might hit rate limits. The local first finance app has no bank integration, so you're manually entering everything. Do you trust these tools with your financial decisions?
That's the fundamental challenge for indie finance tools. Banks and established financial institutions have regulation, insurance, auditing, accountability. An indie hacker building a side project has good intentions and a GitHub repo. If something goes wrong, a bug, a security breach, a data loss, who's liable?
This is why so many of these projects are tools rather than services. They're calculators, aggregators, generators, things that help you make decisions or create artifacts, but don't hold your money or execute transactions. The moment you're actually moving money or making trades, regulatory complexity explodes.
Small Transfers is interesting in this regard because they're using Stripe for the actual payment processing. They're not becoming a payment processor themselves, they're adding a batching layer on top of an established one. That's smart risk management.
Contrast that with the peer-to-peer insurance app, which is actually pooling money from friends and family. What happens when there's a dispute? What happens if the pool doesn't have enough to cover a claim? What happens if someone tries to commit fraud? These are all problems traditional insurance companies have legal frameworks and business processes to handle.
Let's talk about one more theme: the death of the casual side project. Several of these creators mentioned spending months or years on their projects. The QuickBooks app took over 3 months just for approval. The business aggregator is tinkered with once or twice a month for apparently years. These aren't weekend projects, they're long-term commitments.
And yet, most of them are free, with uncertain monetization paths. The invoice generators are free. The bill-splitting app is free and relies on donations. FinBodhi doesn't mention pricing. AssetRoom is described as a free service. These are labors of love, not businesses.
Which raises the question, is that sustainable? Can we have a healthy ecosystem of financial tools built by people who don't make money from them? Or will these projects eventually shut down when the creator loses interest or can't afford the hosting costs?
Some are hedging with dual licensing. Easy Invoice PDF is AGPL 3.0 for open source use, but offers a commercial license. That's a way to keep the project available to individual users while monetizing corporate use. But it only works if companies actually want to use your tool enough to pay for a license.
There's also the succession problem. If these projects are personal side projects, what happens when the creator moves on? Do they shut down? Do they get abandoned with security vulnerabilities unfixed? Open source helps with this. Someone else can fork and maintain, but that requires someone caring enough to take over.
Let's end with some forward-looking questions. What does the future of indie finance tools look like?
I think we'll see more specialization. Instead of trying to build a comprehensive personal finance app that competes with Mint, you build a very specific tool that does one thing well, like the rent versus buy calculator or the bill splitting app.
I think we'll see more curation and aggregation layers. The business for sale aggregator, the SEC filing summaries, the VC funding tracker, these all take publicly available data and make it more accessible. That's a viable niche that doesn't require handling money or navigating regulatory complexity.
I think we'll see more local-first and privacy-focused tools, but only for users who are willing to trade convenience for control. FinBodhi will find its audience among people who deeply care about data ownership, but it won't go mainstream.
I think we'll see continued fragmentation around invoicing and accounting because every country has different requirements. The tools that succeed will be the ones that focus on a specific market and get the compliance right, rather than trying to be everything to everyone.
And I think we'll see AI becoming more deeply integrated into financial tools, but in boring ways. Better OCR for receipts, better categorization of transactions, better summarization of financial documents. Not AI will predict the market, but AI will save you time on tedious tasks.
One thing I'm certain about: finance will continue to be a hard problem space for indie hackers. The combination of regulation, trust requirements, network effects, and entrenched players creates massive barriers to entry. The successful indie projects will be the ones that find small niches where those barriers are lower.
Or the ones that build tools for other developers. Small transfers, for example, isn't a consumer product. It's an API for SaaS companies to add micropayment capabilities. That's a much smaller market, but it's one where the buyers are technical and don't need the same level of hand-holding.
Before we wrap up, I want to highlight one more thing. The community feedback in these threads is invaluable. The detailed critique of invoice generators explained double entry accounting and EU e-invoicing requirements. The discussions about bank linking explained why local-first apps struggle with integrations. The QuickBooks partnership fees revealed platform economics.
This is the value of building in public on platforms like Hacker News. You get real feedback from people who know the space, who've tried to solve similar problems, who understand the regulatory landscape. It's not just cheerleading, it's substantive critique that helps you avoid pitfalls.
Although sometimes the feedback is people telling you your name is confusing and they keep reading it as my fiancé.
Which is also valuable feedback. Naming is hard, and if 10 people independently tell you they misread your name, you should probably change it.
So to wrap up, we've looked at 18 finance and fintech projects spanning invoice generation, personal finance, market intelligence, peer-to-peer insurance, micropayments, business acquisition, bill splitting, and more. The themes that emerge are the gap between US-centric tools and international compliance, the tension between privacy and integration, the challenges of monetization, the importance of trust, and the dominance of network effects.
The most viable projects are the ones adding curation or tooling layers on top of existing systems, rather than trying to replace those systems. The least viable are the ones trying to handle money directly without the regulatory infrastructure to support it.
But all of these projects represent people trying to solve real problems they've encountered, building tools they wish existed, and sharing them with the community. Even if most of them don't become successful businesses, they're experiments that advance our understanding of what works and what doesn't in financial technology.
And some of them will find their niche, the invoice generator that gets EU e-invoicing right, the personal finance tool that nails the simulation engine, the micropayment platform that becomes the standard for API monetization. We don't know which ones yet, but we know some will succeed.
If you want to see the full details on all 18 projects, including links to the tools and the complete comment threads, check out the show notes.
And if you're building something in the finance space, we'd love to hear about it. What challenges are you facing? What assumptions have you had to revise? What surprised you? Reach out through our website.
Until next time, keep building.
Keep breaking.